Hi, thanks for joining us for Financial Symmetry's July 2024 market update. I'm Grace Cavantis, and I have with me Mike Eklund, and we're going to be going over some exciting market slides. As a reminder, this is all intended to be information only. This is not investment advice. So if you have any questions that arise from the topics we cover today, please reach out to your financial advisor. With that, Mike is going to start us off with how markets have been performing.
Thanks, Grace. Yeah, so this is information on the long-term market summary through June 30th, 2024. You'll notice over the last year, stocks, international US stocks have done very well, up between 10 or 12 to 23%. And then also over the last 5 and 10 years have also done well, primarily led by the US. So Grace is going to talk a little bit about that on the next slide. But the one thing I want to point out here is we have only included the performance over the last 1, 5, and 10 years, and not the last month, the last quarter, the last year to date, because we don't think that matters, or investors should be focused on that versus what we think is more important is long-term results. So overall strong, especially stock market performance, as well as the bond markets were up about 3%, almost 3% over the last year as well, but have struggled over the last 5 years given the rising rate environment. So I'm going to pass it over to Grace to talk a little bit about the randomness of global stock returns.
Thanks, Mike. The US has been a star performer over the past 10 years, but historically, that has not always been the case. It goes in cycles. The purple on this graph shows the many times when international companies have outperformed US companies. This is a reminder for us that it is very important to be globally diversified with your investment portfolio. With that, Mike, you want to get a little more specific with one of the companies we might be wanting to invest in?
No problem. I just, yeah, as Grace alluded to, global diversification is really a prudent form of risk management. I always like to joke, you're diversified when there's a part of the portfolio you don't like. Today, that's international stocks. In the 2000s, that was US stocks. There'll be something over the next 10 years. So
Yeah, that's true.
The benefit here to show folks is, by investing in both US and international companies, you'll get the benefit of when each individual market outperforms. So yeah, so the next topic, if anyone has been following the market or the news the last 6 to 12 months, have been focusing on AI, have heard a lot about Nvidia. So Nvidia is a company that's definitely riding the AI wave. And the performance we have here is the performance of Nvidia on the graph on the left, and a performance of Cisco stock, which obviously has a location here in the triangle as well, on the right. And the reason we wanted to show it is because the number one story of the AI boom has been Nvidia. Stock's been up about 3,000%. You hear it in the news every day, and that's 3,000% over the last 5 years or so. We look back many years ago, I'm aging myself, but I remember these days well, is that back in the late 90s and early 2000s, the number one story of the internet boom was Cisco. So Cisco was very similar to Nvidia during that time period. Everyone had to invest into it. The CEO was a celebrity, and that stock over those 5 years increased over 4,000% from March 1995 to March 2020. Now, what happened since then? And this has been almost 24 years now, or over 24 years now, is the cumulative. That's the total return from March 2000 through end of June has been 3%. That's 0.12% per year. Now, Cisco has been a great company over those years. Its earnings have grown. It's done very well, but in terms of a company performance, but its stock has not. So I always like to say a good company doesn't mean a good stock. And so we see that firsthand with Cisco. Now, what's going to happen with Nvidia going forward? I have no idea. I just want to remind folks that this is a risk of investing in individual stocks. The late Jack Bogle always used to comment that you want to, instead of focusing on the needle, you want to buy the haystack. And I think that's, never more common than today, where, investing in individual companies, the majority of them underperform the market over the long term. So with that, I'll hand it over to Grace to talk about probably the next topic of today, which is the presidential election.
Correct. It's a presidential election year, which makes a lot of people start to wonder, what does this mean for my investments? And should I make any changes, particularly if I think one person is going to be elected over another? So this chart shows that the market tends to continue trending upward no matter who is in office. So when it comes to your investments, you don't need to make any knee-jerk reactions. No need to be afraid. Just hang in there and you should be just fine. We can see on this chart there's red and there's blue, but the upward trend into the right has continued.
Yeah, it's a good point, Grace. You don't make any material changes to your portfolio based upon your political views is my key takeaway. And to that comment, shareholders as investors in companies are really focusing on serving their customers and growing their businesses, regardless of who is in the White House. And kind of the common joke I like to say is the market doesn't care about red or blue, they care about green, which green is earnings. And so once again, as this next slide is going to show us, it's important not to make drastic changes to your portfolio based on your political views. So this is an interesting two graphs from BlackRock, taking a look at if you only invested when Democrats were in office and you only invested when Republicans were in office versus investing the entire time. So if we look at the graph on the left, this is over the last 10 years. If you invested over the entire time, your portfolio was up from 100,000 to 311,000. If you only invested either when Democrats or Republicans were in office, your balance was almost half as much as that. And then the graph on the right takes a look at that same numbers over the last 70 years, which shows the benefit or the value of compound interest and how much more you would have had by investing the entire time. So once again, don't let your political views impact your portfolio decisions. And so this slide as well. So a lot of folks have been, cash returns have been very good lately because the interest rates, the Fed funds rate is over 5% today. So many folks feel like, why invest in bonds, especially because their performance over the last 5 years have been not very strong. But the risk with cash is reinvestment risk. So as this graph shows here is that the market right now is thinking that the federal funds or the Fed will reduce interest rates 4 times over the next year. So when that happens, the yield you get on your cash will go down. And so with a bond investment, we're not looking to talk about long-term bonds, but short, intermediate-term bonds, you don't have that reinvestment risk, and you will continue to get that interest rate that you had when you invested in that bond. So our focus is, short or intermediate-term high-quality bonds, because there is a risk with cash of reinvestment risk. So with that, I'll hand it over to Grace with a little bit more on some market outlook views.
Yes, so we've talked about how the markets did in the past and some current topics. This looks at Vanguard's mid-year 10-year market projected returns. And we can see in these teal bars that the highest expected returns is in international companies. You can also see the ones closest to the left with the lowest expected returns are U.S. companies, and in particular, U.S. growth companies. So just another reminder that just because something has been doing really, really well over the past decade does not mean that that's what will continue. According to Vanguard, that is not expected to continue.
Great. Thanks, Grace. And to wrap up, we have shown this slide on the previous quarterly webinars, but I always like to remind folks on Financial Symmetry's 3-step investment process. As a reminder, we don't develop an investment plan until we complete a financial plan. And so that's based upon when you need the money. So money needed in the next 5 to 7 years, we want in short, intermediate term, high quality bonds, and then money needed after 5 to 7 years, we didn't want to invest for long-term growth. The next step of our process is to implement. That's actually, choosing the individual mutual funds and ETFs that are tilted towards higher expected returns to help reach your goals. And then the final part, which a lot of folks I don't think do as a good a job as I could, is monitoring your plan, which we like to call opportunistic rebalancing. When the market drops, we want to buy, and when maybe it gets a little too expensive, we want to trim as well, and then adjusting your portfolio based on changes in your situation, like retirement, maybe the kids are going to college, buying a second home. All those items will impact the portfolio. And then finally, to wrap up, if you have any other additional questions, happy to contact Financial Symmetry. that information on our investment strategy. You can also fill out our Talk to an Advisor form to speak to an advisor about your portfolio or any investment questions. And then finally, if you have any specific questions for Grace or myself, our contact information is here. But we want to thank you for listening to our quarterly webinar, and we look forward to talking to you again in October.